Okay, we move to financial management environment objective test questions. Total question that we would like to go through is 9, and we go through 5 questions first. The financial management environment question test objective test question number 1. 3 statements. Okay, which statements is or are correct? So what's the statement talking about? It's about the securitization. It's about the intermediation. So let's check. For the first statement, securitization is the conversion of illiquid assets into the marketable securities. For securitization, it means a bulk of assets, like, for example, mortgage. Okay, for example, mortgage. Mortgage to the bank is their assets, because the borrower asks the bank to borrow their money to buy flats or house, then it's a mortgage. And from the bank point of view, the mortgage is their asset because it generates interest income from the borrower. And the issue of the bank is it has a lot of different types of mortgages, okay, and different people. Then it manages the mortgage separately. And if the bank would like to convert, like, for example, to cash in the mortgage, if they would like to increase the cash level, how can they do? They will, for example, so the mortgages, there's a lot of mortgages, maybe 1,000 mortgages in a pool. So the bank decides, say, for example, 200 mortgages will be bounded together, or will be bounded together and sell to investor. Okay, so the investors will have the interest to enjoy the interest income from these 200 mortgages. And in between, there may be an administrator to do the administration job, and the bank can cash in from the investors because the investor pay the bank to have the interest income from these 200 mortgages. Then it is for these 200 mortgages bound together, and it can be issued a security for different investors to buy. So it is the concept of the securitization. So the statement 1 is correct because it describes the key point is for illiquid assets and person owned, maybe a bank owned, and it would like to convert into cash by selling these illiquid assets. What can he or she do is to bound all the illiquid assets together, for example, mortgages, and then to issue the securities. The securities is just based on the mortgages, and the holder of the new securities can be share the benefits from the pool of illiquid assets, like here is the mortgages. So the second statement, the reverse yield gap refers to equity yields being higher than the debt yields. So equity yields means the return from holding equity, and the debt yield is return from holding debt. All right, and normally the yield gap is equity yield minus the debt yield. It is normal because the equity holder required a higher yield as compared to the debt holders because of the risk exposure, the creditor hierarchy structure. So in general, equity yield should be higher than debt yield. It is normal yield gap. And the reverse yield gap is the opposite. It is the debt yield higher than the equity yield. Because the statement here is saying that the reverse yield gap refers to the equity yields being higher than the debt yield, it is not correct. Okay, it should be debt yields higher than the equity yield if it refers to the reverse yield gap. So it's not correct. For number 3, this intermediation. This intermediation arises when borrowers deal directly with lending individuals. So in other words, financial intermediary here is to link up between the borrowers and the depositors. Say here, we have the borrower and we have the people saving, which is they put the deposit, and the financial intermediary is to have the depositor money into the bank. For example, it is a bank as an intermediary, and the bank can lend the money to the borrowers. But here saying that if the borrowers can directly deal with the individuals, it can bypass the bank. Then what's the process? It is this intermediation, because no more intermediation in the process. So it's true. So the correct answer here is 1 and 3, B. Question 2 of the financial management environment. Which of the following is or are usually seen as forms of market failure where regulation may be a solution? So when we talk about the government intervention or government policy, sometimes it refers to the market failure, then the government would like to involve or step in to fix it. And here, number 1, imperfect competition. It means that the market may be in a situation of monopoly or oligopoly. If it is the case, it means the competition is not enough or imperfect. Consumer needs to pay a higher price for the products. So number 1, yes, is correct. The market failure, because the competition is not enough. Second, social costs or externalities. It may refer to the pollution. Imagine if a factory is built in the center of London, and the factory is a dyeing factory, which a lot of polluted waters emitted from the factory, a lot of bad smell from its operation, from its manufacturing activities. Then what's the impact to the nearby, or what's the impact to the neighborhood of this factory? For example, if it is in the heart of the London, then it is a disaster because the neighbor will be suffered. So the social cost will be increased significantly, or externality is going up. Then the government intervention is required. The government needs to have the policy or the green, for example, the green policy to ensure some areas in a city is restricted to certain activities, like only for commercial activities, only for residential activities, but not for industrial activities, to ensure the neighborhood life is not affected. So yes, the government regulation may be a solution to this situation. The third one is imperfect information. Imperfect information means there's not enough information in the market and the consumer is blinded and cannot make the decision based on the information provided or based on the not enough information to make their own decision. So government may help, for example, if provide information by the government and is transparent to the consumer or to the people in the city, in the country, then it can help the markets to perform regularly. So it's true. So the answer here is D, 1, 2, and 3. Number 3, which of the following statements are correct? First, monetary policy seeks to influence aggregate demand by increasing or decreasing the money raised through taxation. Okay, for monetary policy, it is about the bank, about the money supply, about the interest rate. And for fiscal policy, it's about government income and expenditure. The income is tax, and expenditure may be the subsidy to the industries or government expenditure, government projects, infrastructure projects. Okay, so number 1, when we talk about monetary policy, it should not be any tax here, so it's not correct. The second, when the governments adopt a floating exchange rate system, the exchange rate is an equilibrium between demand and supply in the foreign exchange market. Okay, when we study the foreign exchange or risk management on Forex, we are concerned about the exchange rate impact to a company, but how about the government adopt a floating exchange rate or fixed exchange rate system? If a floating exchange rate system, the exchange rate will move, okay, based on the market demand and supply, yes. And the exchange rate will be at equilibrium based on the force between demand and supply. Yes, it's true, because it describes the market situation or determining the exchange rate. For the third statement here, it talks about fiscal policy. Fiscal policy seeks to influence the economy and economic growth by increasing or decreasing interest rates. Definitely is not correct. We just mentioned for monetary policy, it is about the money supply, about the interest rate adjusted by the government, central bank, and the fiscal policy is about the government income, which is tax, and also the expenditure by the government. So here the correct answer is only 2A. The answer is A. Question 5. Here, there are 3 types or 3 institutes here, and which are financial intermediaries. So remember, financial intermediaries, okay, we talk about financial intermediaries. Here is the depositors. They put savings or they put money to the financial intermediary, and there is a borrower. They are required the funds, okay, for the operations or investment. So here for venture capital organization, yes, venture capital organization is a financial intermediary because they raise the funds from each individual and they will invest the funds to a particular company. So once the company is, for example, running a successful business, it can generate a lot of cash to pay dividends to the shareholders, including those venture capitalists. The venture capitalists can enjoy the dividend income and paying back to those providing the funds to the venture capital. So venture capital is a kind of financial intermediary. Second, the pension funds. Pension fund is yes, because for each individual, you just put your money in a pension fund, and once you retire, you will have the funds back from this intermediary. Or for those people, they are retired now, they can get the funds from the intermediary as well. So pension fund is managing between the depositor and the receiver, or the person who just got the money from it. So pension fund is a financial intermediary. 3, the merchant bank. Merchant bank, yes, it is a financial intermediary. Merchant bank is not just an advisory institute. It also manages the funds flow, like the investment banking, between each individual investors and the organization or institute would like to have the money being invested in their business. So here, the answer is D, 1, 2, and 3. Number 6. Here are 3 statements. So ask you which statements are correct. Okay, it is very common type in the financial management financial management environment questions, especially in session A, because it is mainly a conceptual question, and a lot of students, when there are concepts and the knowledge is not clear and it's not enough, it is very challenging for them to answer this kind of question. So let's look at the question 6. Which of the following statements are correct? Okay, third statement is the capital market securities are assets for the seller but liabilities for the buyer. Is it true? It's not true. It's not true, because during the transactions, the seller will receive cash from the buyer, and the buyer of the capital market securities will enjoy the economic benefits from it. So it's not the liabilities or assets of each another. Okay? The second, financial markets can be classified into exchange and over-the-counter markets. Yes, it's true. Right now, we are generally divided the financial markets in 2 types. The first one is those products or those securities listed in the exchange, so the people can trade in the exchange. And the other is in the over-the-counter markets. It means that you have to go into a private sector to sell your securities with a particular institute, and the institute will find the other guys to buy your products, or they would like to hold it maybe for a particular time. And 3, let us read the third statement, whether it's true or not. A secondary market is where securities are bought and sold by investors. Yes, it's true. It's a definition of secondary market. So the answer here is C, 2 and 3.